Okay, now we get into related parties, and I've said we are now looking at auditing related parties. Before we can consider how we go about auditing, we need to understand what related parties are and why are they so significant that there's an entire auditing standard dedicated to them and there's an accounting standard dedicated to them. What makes them so special? So, first of all, what are they? Per IAS 24, so your accounting standard, a related party is a person or an entity that is related to the entity preparing its financials. Okay, so then how do they define the relation? Well, if it's a person or a close member of that person, you will be related to the entity if you've got control or joint control over the entity, significant influence over the entity, or you are a member of key management for that entity. Or if you are an entity, you will be considered related to the entity if you are members of the same group, or you are an associate or joint venture, or you are both joint ventures to the same third party, so ultimately you're now in that same group, or one entity is a joint venture of a third party and the other is an associate of that third party. So once again, members of the same group. So that's what would be defined as a related party. They then also just further say that a close member would include children, dependents, or a spouse for that person. That's the definition of related per IAS 24. So now we understand it, but what makes them so special or significant? Why do we need to pay special attention to related parties? Well, guys, think about it. Think about you. Would you act differently towards your friend or family member than to a stranger? Yes. So, because there's this relationship, the relationship means there could be collusion. There could be favoritism that could affect the presentation of a transaction or balance in the financials. They could work together to act fraudulently, collusion. So we need to pay special attention to related parties as the auditors because there could be misstatements in the financials as a result of the relationship. Collusion, favoritism, so ultimately could be risk of material misstatements in the financial statements. That's why we must pay special attention. That same risk doesn't apply to a standard customer or supplier because there isn't that relationship that affects their decision making. So I just say, the auditor has to identify the risks when performing risk assessment procedures in order to understand the entity and its environment. Remember, guys, when we understood the entity and its environment in the planning stage, we looked at its structure to understand, are they a group or is it a single entity? And through that, we would then ultimately identify related parties. So we would know right up front if they have related parties based on just their structure. Okay? And then from that understanding, we automatically need to make the connection. Oh, well, because they have related parties, because there are relationships that are affected by the structure, there are going to be risks. Now, we've already throughout identification of risks been picking up risks with regards to related parties, so it's nothing new, it's just now you need to understand it so that you can go and audit it. So what are those specific risks? It's the risks of non-compliance with the IFRS requirements. IFRS requires that related party transactions are disclosed and are at arm's length. So, the first risk, the risk that a related party relationship is not disclosed. Even if they don't transact with that related party, they need to disclose the relationship. The second risk is that the transactions with related parties are not at arm's length. And the third, that they then don't go and disclose the actual transactions. Okay, because guys, IFRS requires that they do this. IFRS requires related party transactions are disclosed and are at arm's length, and that any relationship with a related party is disclosed, so that the users of the financials can see where there are closer relationships because of the related party nature. And so guys, as soon as we identify a risk, we need to come up with responses. So we are going to have a way of responding to make sure that related party relationships are disclosed and the transactions are disclosed and are at arm's length. Before we get into how we go about doing that, guys, it's very important to see this. We noted here above what could happen because of related party relationships: collusion, favoritism. And collusion implies a fraudulent type of risk. So if we look at the next slide, we can see where in the standards related party risks have been identified, so you can see how serious the risk is. ISA 240, we haven't quite got to that yet, but we will get to that standard. In paragraph 33C and A49, they describe that significant transactions outside the normal course of a business with related parties give rise to a fraud risk. That's that collusion. And in Appendix 1, they say that there is opportunity for fraud when there are related party transactions. So here's a huge one already. Now we're saying related party transactions give rise to fraud risks. In ISA 315, we've done this. They specifically note that significant disclosure is required for related parties and their transactions. Paragraph A204. And so that means, guys, if they require this disclosure because it's significant, this gives about a significant risk. If there is non-disclosure. And then ISA 550, the related party standard, paragraph 18 says that significant related party transactions outside the normal course of business give rise to significant risks. So what we are seeing here is that when there are related parties, there is going to be a significant risk. And I know that if there's a significant risk, the response is that we need to go and, 1, understand the controls around the managing of that risk, and 2, we have to do substantive testing to make sure that that transaction or that disclosure has been done correctly. That's a significant risk. Also, just to note that if we want to test or use the controls as evidence, we have to test them in that year. Okay, we can't rely on previously tested because there was a significant risk. So now we're seeing the gravity of the related party risks. We see the risk is that they don't disclose the relationship or the transactions, and that the transactions are not at arm's length. But the type of risk that's associated with all 3 of those is a significant risk. So we have to, as auditors, respond to those significant risks. Guys, just to be aware, what are you looking out for in a scenario to help you to see, there are related parties, other than the easy you can see the person has control or is key management, or you can see the entity is in the same group. What other pieces of information in a scenario could help you to go, who is this a related party? Is this a related party transaction? So where a transaction is overly complex, it could be an indicator of a related party. Where they have transactions with offshore entities in jurisdictions with weak corporate laws. So they're trying to find ways to get around a law or regulation. Where they're leasing of a premise or rendering a service for no consideration. That could be because they're doing so with a related party. Where there's sales with large discounts or returns, or circular arrangements in transactions. So example, they make a sale but they commit to repurchase. Why? Who would do that? Maybe a related party would allow them to do something like that. Transactions where the terms change before it expires. Transactions that lack apparent logical business reason. Why are they doing this? They're trying to help a related party or get help from a related party. Where the substance differs from form, or it's processed in an unusual manner, or there's abnormality in the transaction, whether it be trade or unusual prices, interest rates, so on. So those are just some things that you should look out for in a scenario that could indicate to you there's a related party or related party transaction taking place. Okay, they might not spell it out for you, but this is the stuff that you look for to help you to go, oh, that makes sense, this is a related party. Okay, so how do we respond? The types of questions we get asked are to identify related party transactions. So they're saying to you, what do you need to do as an auditor to identify related party transactions? And guys, this is going to help you to ensure that they record and disclose all of the related party transactions. So this is going to help you with risk 1 and 3. Those are the procedures we would be doing to help us with risk 1 and 3 to make sure that they record all related party transactions that they enter into. We have to perform procedures to pick up all related party transactions so that there aren't any that are not disclosed that should have been disclosed. Okay? Second way you could be asked is to audit a specific related party transaction. So in this instance, you are just auditing one transaction with a related party. They've asked you to audit it. So now you are not trying to pick up any that are not recorded. Or disclosed. Now you are trying to address the risk that it is at arm's length, or that it's not at arm's length. So when you have to audit this, you want to audit that the transaction has been recorded completely, accurately, it occurred, it's in the correct period, in the correct date, and it is at arm's length, addressing risk number 2. And then the third way you could be asked to test related parties is to audit all related party transactions. This means you need to do 2 things. The first thing you need to do is to identify all related party transactions. So that you can ensure that they are recorded and disclosed. So risks 1 and 3 are addressed there, but then you need to then go and test the detail ultimately to make sure that it is at arm's length. And so here you then address risk 2. So for the third type, you are doing lots of work. You're trying to pick up all transactions first, and then you are going to audit them. Whereas 1 and 2 is only addressing one element of the risks. First one, just identify related party transactions. You are just trying to pick up all of them so you can ensure that they are all recorded and disclosed. And the second one, you are just auditing one transaction, so you are just going to test the detail that it's at arm's length. But when the two are combined, you need to identify all related party transactions and test them. You are addressing all three risks. The risks that the relationship is not disclosed and the transactions are not disclosed, and the transaction is not at arm's length. So how do we go about responding to the risks and ultimately answering these three type of questions we get asked?